Greetings, family. So today I'm teaching you a full smart money breakdown class. This is class part three of this. Please do watch part one and part two, but I will quickly make you guys remember exactly what we covered. And for those who are just joining us on this video, this is going to be one of the most life-changing videos I've ever done for the YouTube community. So make sure you do watch till the end. Now let's just jump straight into it. So in the first part one, I was teaching you guys about how to really understand trends. And we spoke about the nature of the market giving us your, let me just use a different color over here, something bright, where if we're in a downtrend, it gives us lower lows, higher highs. This lows over here and highs, or this peaks, we call them lower lows and lower highs, lower lows, lower highs. If it's a bullish market, then it be um, higher low, higher highs, and higher lows. Okay, creating higher highs. That's in essence what we covered on part one, and also understanding the phases of the market to say if the market is in like the actual trend. When it's pushing that, we call it an impulse move. When it's pulling back, we call it a pullback. Impulse and pullback, impulse, the very same thing with the bullish market. If it's in a bullish trend, we call it an impulse with a pullback and an impulse. I hope we do understand that. It was just a few things that I'm just summarizing right now. Okay, so we have higher highs, higher lows for the bullish market, with lower lows and lower highs for the bearish market. And then we also got to an understanding about understanding higher time frame, what we call order flow, and lower time frame trends, what we call micro trends, and using that in line to get supply and demand together with the trend. We also established the main um, function of trading is to buy low and sell high. So understanding how trends and supplies and all of these orders are really gives us a good nature where to buy and sell. Okay, and through that I introduced, so let's say this red over here, I'm gonna say red. Let me just do it nicely here so we can have something proper. Okay, let's say red. Red represents the lower time frame, okay? And then of course the black represents the higher time frame. So I'll just write the B represents the higher time frame. Okay. So as you can see, the black here, it's the bigger trend. On the bigger trend, we can see that the market is in a bearish trend. On the micro trend or the lower time frame trend, we can see that the market is actually showing us, or in this example, I'm actually showing you what happens when the market is in a selling market. In the actual main trend, what happens when it pulls back. In the micro trend, that's also giving you guys an actual trend that takes place that has higher highs and higher lows. Then when the market sells on the bigger trend, it also gives you a lower time frame trend that has lower lows and lower highs. And why am I highlighting that? Let's actually separate them there so I can show you exactly what I mean. Okay. Okay, let's zoom in quickly here so I can show you exactly what I mean by this. Look at this. This would be the lower time frame trend. We can see that if we continue to draw what I just drew there, I'm just going to draw it this way. You guys will understand exactly what I'm doing now. Um, let's just play back a bit. Okay, this would be the higher time frame trend, saying we're buying. Okay, okay, so we can clearly see that in a lower time frame trend, we can see that the markets are giving us points of we get something here where the markets are giving us points of lower lows, lower highs. And as I said, we want to buy low and sell high. So how do we do it? Understanding order flow, we did establish. I'm just recapping, guys. Understanding order flow, we did establish that if the order flow of the market, understanding the order flow, we can know where to buy or sell. For example, in this case, if the market was pushing as a pullback, we can know that we are buying within the main pullback of that trend. So if the trend is bearish, that means that if we are buying, we know we're just buying. And of course, when do we buy? When we are presented with markets, when we have created higher lows. And how do we do that? Of course, we can see that we have an impulse with a pullback. When the market pulls back, it creates a higher low for us where we can actually just buy that market low. How now do we do that? Through supply and also through demand. Now, let's go ahead. Let's say now again, you've identified that we've initiated the order flow on the higher time frame. And what I mean by higher time frame, daily time frame, that's the red there, that's the black. And of course, the lower time frame is your H1s, M15. I did cover it. Please do refer to part one. Okay. Let's say here you can identify, you can see, okay, we are created higher highs, lower lows, lower highs. Therefore, you can just see that we're actually now in a downtrend. When the market now, you stretch that across, the market actually gives you an impulse, giving you lower low, pulls back, giving you lower high. You are now, of course, sell right there until it gets to exhausted because we're now going higher. The very same thing I've taught you here. Okay, I've taught it within the actual part one. Please go check that out. Just a market recap over here. Now, I taught you how to identify supply and demand through a concept where we say a supply needs to have a, if we're speaking about a supply, it needs to have a rally, so the market going up. It needs to have a base where the price is congested into a zone like that where it doesn't go, it wastes some time before taking off. Okay. And this preferably would be a lower high. Okay, we have yes zones in between, but this preferably it would be a lower high. And of course, through creating that base, we have now a drop. Then the market pulls back to that, and then we can actually sell that off. When we're speaking about demand areas, when we're speaking about demand areas, we spoke about identifying it in the sense of knowing very well that we're going to be having a drop, we're going to have a base, and then we're going to have a rally. When the market pulls back, we pull the trigger on that zone. Okay. That was mainly part one and part two in terms of teaching you how to, I think it was still part one, how to make you identify now those zones. And we say if you're going to find those zones right here, preferably at lower highs, but then we also practically we have other zones in between. So how do we now do that? We got to the conclusion that you can use a Fibonacci. I taught you in that how to really draw up your Fibonacci in terms of really putting it from 1 to 0 over there. And we spoke about the discount market where from 50 all the way to 100, we have the premium markets. We have from 50 all the way to 0, we have the discount markets. And we say that when you are preferably looking for sales, you want to look for them in the premium markets, right? And then that's where you want to see your zones and spot your zones at. And we spoke about sweet spots and so forth. Please do look for that. The very same thing where to apply for a bullish market. Okay, let's just erase everything here. The same thing would apply for a bullish market. Actually, let's put the Fibonacci over here. Okay, if this was the zone over here and the market starts pulling back, it should pull back into a discount market. Okay, from all the way from your 50. Okay, so this would be the discount market. And of course, the sweet spot there is to buy between 1 and 78. And then that's where, if there's a zone that has a drop base rally, that's where you take it, right? And that's what we concluded in the last lessons more so ever. And of course, we did talk about trend validation to say, as well as change of characters. I'm gonna have to just draw something new for this one. Let's go over here and erase everything. So we spoke about trend validations in the previous ones. I'm just recapping so I can build on. We spoke about trend validations to say if the market was in a downtrend, for example, giving you higher highs and higher lows, and the market suddenly breaks a previous lower high over there, and now starts to give us something like this, then we can say this whole motion here is a change of trend where we have a previous higher low that was broken. Let me just play it back here. We have the previous lower high that was broken. We have the break of structure. We talk about spotting true change of characters. We talk about, since this is broken, we call it chalk. Okay, change of character. And of course, through that, we can now know we are in an uptrend. If the market does not take breaks of structure, but breaks a higher, it's just going to retest another zone particularly. Okay, you can watch that. Now, let's talk about liquidity. Let's talk about fair value gaps. That's what we want to talk about. And I'll be piecing everything together over here in terms of really making you to understand. I lost on a setup yesterday on US 30, and I'll show you why. Because of hindsight, it looks quite simple. Okay, but let's go over here just to cover exactly in terms of the rules and things that I taught you. Look at what we are. This is the daily time frame now. We are mentioning the main order flow. The main order flow, we can clearly see it from here on. We've been in a bullish market. Okay, that's the main order flow of this. We've been in a bullish market. So therefore, when I go to lower time frames, if the market has not given us chalk, we're still in a bullish market. Okay, I was expecting sort of sales to pull back. If you can see my prediction, they're still gonna do that. But in terms of this teaching, I'm just gonna teach you from this example. We can still see that we're still within that main leg of the bullish order flow. So now when I go to a lower time frame like your H1, we can clearly see we're still in a uptrend. Why are we still within an uptrend? Because the market has not broken this higher low. If it broke it, then this would be a change of character. Then we'd conclude that structure would now be going lower. But structure didn't break this point. So therefore, sales were invalid. And I knew that, hence I was looking forward to buys, right? Okay. So check what I didn't do. So after identifying, okay, that this is the trend that we have, because I taught you guys trend validation, right? I taught you that when you take, you can see that structure did actually break the previous higher high, showing us that we're still validating to be going higher, okay? And we can also see previous other breaks of structure over here that the market broke, okay? We can see that. Now, we can identify which trend or which impulse broke this previous higher high. It started from here. And then from here, we can actually get to identify that this is the demand level over here. Okay, that's theory, guys. It looks easy, right? But when you're breaking your rules, for example, I've highlighted this. Okay, this was my demand. Okay, there's another one over here. We have a demand again. Okay, in between over here. Again, here we do have a demand. So this whole thing must have been actually a demand, okay? Because we can see that price was quite congested over here, okay? Now, given that, look at this. It was easy because now you can see what took place. It's easy to see that was a stupid mistake. But many of you go through this daily. So how do you now do that? You've validated, all right, we're in a bullish trend. You know the order flow that we are in an overall daily time frame. We are bullish. So you've established your daily bias. You've established that the trend is still bullish by having your change of characters over there or your breaks of structure. You can establish that this is the impulse that the market has created. But where do you now buy? Okay, what is liquidity in this case? And I taught you through the Fibonacci. This is where now we get that whole thing. Okay, so we can see when I place the Fibonacci there, we have 0, we have 23, we have 38, 50, we have 68, we have 78, and 100 over here. And of course, now we can now label all of this stuff, okay? From 50 all the way, from 0 all the way to 50 premium, okay? From 50 all the way to 100, we have the discount, okay? Can you guys see it? So with this impulse there going further up, as it pulls back, I'm looking to buy where? In this area. But now, look at it. I was particularly right with the zone. Now, when the market tapped into the zone, it started buying and I bought right here. Beautiful entry. I bought. I was targeting higher highs. Okay? As I bought, the market just moved all the way with put take profit one over here. This was signals, by the way. We'd put take profit one over here. The market, of course, just turned around slightly and then went for this zone actually here and stopped us out. So we became liquidity for USD, stopped us out, and now it's going higher. So what was our mistake here? What did we miss? Okay. What did we miss? Now, let me teach you. Let's go ahead. What did we miss on this? So we are right about buying within this area. We can see that we're in a nice discount market. Okay, good. So given that we had the extreme zone over here, the market was going to definitely use that. We can see on the 4H as well. So when I talked about the order flow, also confirm with the 4H, I like to look at valid zones on the 4H. We can clearly see that on the 4H here, this zone, okay, number one, you can see it that it was going to be invalidated due to the response of this 4H candle, the momentum of that. Remember, guys, I taught you that the market has to slow down in order to show us that it's going to turn around. In this case, we're not slowing down. Okay. In the mentorship, we have a good aspect called triple R: reduction, rejection, reversal. In this case, there was no reduction. The market just went in on this one. It was not turning around. It turned around slightly, but it still went further. So it was just the market liquidating us. So paying attention to candlesticks on the zone is very much important. Now, look at this zone here in the response. The market, of course, goes all the way here with so much momentum. It does not continue like here, where we have this candlesticks, right? It sort of just slows down. And if we go now to H1, we can see that it was a beginning of a slowdown before it went all the way here. When it got all the way here, it was now beginning to spike. So what I would prefer for you, my learned friends, is that you take a valid zone. Look at as well the invalidation of the zone. A demand, as I taught you guys, it needs to have a drop, base, and a rally. This one has rally, base, rally. Okay? You don't want such zones. You want such zones where you have a drop, you have a base, so candlesticks played a bit here, and a rally. So you can now use that as a valid zone, as well as it was in the sweet spot of the market. It was the last higher low, therefore this was a valid zone. So I would rather prefer for you to look for higher lows where you have the drop base rally, as well as it's within the discount markets if you're buying. Then now look at the liquidity here that the market created. So now it used this zone as liquidity for all of the traders that were willing now to buy at that point. Okay. For now, of course, by hindsight, we can see that the liquidity was this point, but by then, the liquidity was this low over here. Okay, and I just label it with an X. We can see that the liquidity, it's basically that the market, of course, induced us to buy, and it stopped us out, stop losses over here, took our stop losses, and now with so much momentum continued up. So when we're talking about liquidity, it has to give us a formation like this. Okay, let's say we're in a trend. Okay, this would be the actual trend over here, the impulse. The market does this. Okay, this would be the zone. And it's most likely that it can really come back over here and actually take this zone and then go back up. But now it has took liquidity for those who had bought right here. And that's what actually happened with us, as we can see per that zone. Okay, that's what we can see over here. That's what happened with us per that zone. Now, I'll show you examples of fair value gaps. I don't usually trade fair value gaps or look for fair value gaps. They're quite powerful in the sense that you can spot it, and it's usually for scalping purposes on my end when I trade fair value gaps. Now, fair value gaps occur when the market is in a strong momentum. Okay, it doesn't have time to pull back, therefore, it creates insufficient price movements through candlesticks. I'm gonna take this one over here. So as you can see, this candlesticks here, usually a candlestick has to go below 50% of that candle to really cover with a wick. Okay, let me just show you what a proper, you see, this are proper candlesticks in terms of it needs to cover the previous points of the candlestick. Let me just draw something here to illustrate. These are two candles. Okay, normally candle, when price opens, it needs to at least open at least midway, and then that's when it sells. Okay, giving you a wick like this, something like this. Okay, giving you a week almost like that. But if the market does this, where bullish momentum or bearish momentum, it just goes ahead, opens from the closing price, then it didn't actually just go to mitigate within the candle or the last push of that candle. I'm not sure how I can further articulate it, but in that term actually. Okay, but I'll actually show you a practical over here. As I said, I'm not really a fan of fair value gaps, but look at this. Okay, we have this low from this previous candle with this low. Okay, this was a momentum candle. So we take the low over there and we can see that when we find that gap there, fair value gap, okay, or that imbalance as other traders can refer to it as, we can clearly see that this fair value gap was actually filled up and the market used it to actually buy. Okay. As I said, it's for markets that are scalping. So, or rather markets that are very volatile, you'd usually scalp. Otherwise, just wait for that market to pull back to a supply. For example, I would have entirely avoided all of this. Okay. I would see, okay, it created an impulse over here, creating for us a higher low. You can see that high low that was created. And I can clearly see from then on, we did have the market giving us a drop. Okay, we have a base over here. We have a rally. So therefore, I would have taken this, okay, and then of course stretch it across. Then we can see that through that zone, we got a proper entry for the market to sort of just buy further to create higher highs. And I could have just took this entry instead of the fair value gap over here. Okay. As you mentioned, I want to teach you more of supply and demand. It's much easier for a beginner. We do cover it a little bit more. I explain it a bit much better because of the resources that we have within the mentorship. I explain it a little bit much better, but still the emphasis is on supply and demand because that's when you can hold more trades. You're trading together with the market and so forth. But if you're going to trade fair value gaps, your lower time frames are the best, like your M5 and so forth. Volatile markets are the best for you to get those opportunities. Like, for example, look at this. This was today's market. The market left off over here. There was a lot of momentum. We have that fair value gap that the market used. This was an M5. Okay. M5. And as you can see, the market came back to this and then rallied all the way there up. It's just for mainly scalping purposes. Okay. Mainly scalping. Yeah, so that's about it for this class. I don't want it to be too long. So this is part 3, and then we can go into part 4. I'll piece everything together. Again, family, if there's more information that you want, we have other smart money classes that we've done in the past. Please do check them out. Or if you really want to level up and learn as quick as you can with so much structure and approach and articulation, well put together content, we do have that in our mentorship. Why am I telling you this? Because we have a 4th year anniversary this October where we are offering you guys 60% off our course. So if you're really interested in leveling up your journey and becoming part of a community that's really going to give you powerful resources and understanding and comprehension, then the mentorship is definitely for you. 60% off. It's the cheapest we make it throughout the whole year in terms of specials. We do this just once a year. And then if you don't join now, you'll have to wait till next year. Next year, by this time, probably I would have stopped taking in students for we'll be focusing on other projects as well in life. But thank you so much, guys, for joining. Make sure to get all the info about that special in the description of this video or in the comment section over there. See you on the next video.